Okay, starting week number 5 today for Financial Foundations. I just got the new materials posted this morning. This is our sort of our transition time where we go from talking about macroeconomics, the big picture economic stuff, to more household related personal financial management topics. And so today we're going to be talking initially about credit cards, how you get credit, what goes into your credit, how you're scored, all those kind of things that affect your ability to get a loan, buy a car, get a credit card, and it might even affect getting a job. Why? Anybody have an idea why credit score might affect your job prospects? They're going to trust you more. Yeah, that's a really good point, Sarah, because if you think about if you're gonna get any kind of a job involving handling money or accounting for money, and your credit score is terrible, or you've had to file bankruptcy, you're probably not going to get that job, just because an employer wants to trust that you know how to do those things. And if you can't do it in your personal life, why would the employer think that you can do it for them? And so that's another reason that having a good credit score is valuable.
So that's why also it is like the first time if you go to the bank and you want to get credit, they're not going to give you direct credit card. They're going to like open first time like security credit for you.
Secured credit?
Yeah, they're going to open security credit for you for 6 months or from, I think it's from 6 months to 1 year. They're going to see like how you're going. Then after that, they're going to give you.
Yeah, and secured credit is really, it's not really credit, because most of the time you have to have that amount of money on account somewhere, like in deposit. And what the bank is trying to gauge with those kind of accounts is, are you going to pay them back reliably? What's your process for payback? So that's a lot of times, if you have no credit at all, that's a good place to start. There are other ways, though, to start to establish credit. Think of any? Anybody know? What kind of card? Car loan, yeah. And okay, well, if you have no credit history, you're probably not going to be able to buy a house without some really expensive terms. Car loan, though, is a little bit different, because I know through the credit union that I belong to, if you have a savings account with the credit union, they're almost automatically going to give you a car loan. So credit unions are typically a little bit, I wouldn't say lenient, but more flexible as far as who they loan money to, because a credit union is different than a bank. A credit union is like a co-op almost, where the members are the people that benefit. It's not the corporate owners or a bunch of people that are stockholders. So what a credit union does is supposed to benefit their members, and what's going to benefit the members is, in this case, getting a car, so you can get to work. So that's one good place to start if you're trying to establish credit. Maybe you don't start off with a car loan, or not a brand new car, but a used car, a decent new used car. Any other ideas?
Credit card, a low credit card.
Yeah, a low credit card. Sarah mentioned secured credit, low credit card, low limit credit card might be a way to start. Credit unions also are involved in mortgages and issuing credit cards, so you might be able to start off with your credit union on something like that. Department store cards are another good option, like Target. I don't know if you've ever shopped at Kohl's or Macy's, you know,
Cabela's.
yeah, any of those, any department store. What do they ask you when you're checking out? Would you like to put this on your Macy's card? Oh, I don't have one. Oh, would you like to start one? It'll only take a minute. You know, they want you to have their card. And you know, sometimes it might be a $300 limit or a $500 limit or something like that. But that's okay. It gives you some place to start, you know, and if you pay it on it regularly, you're supposed to pay every month. You know, that goes on your credit score. That's going to help you. Regular, timely payments. Other types of any type of credit that you can establish will help you with future credit needs. Credit is scored by the major credit agencies. Equifax and TransUnion are two of the three. And I'm drawing a blank on the third one. This always happens. I can always remember two, but not three of them for some reason. And so these companies will report your credit pattern to the credit agencies. And you're entitled to get a credit report free once a year. If you're ever denied credit, you're entitled to see a copy of your credit report automatically. You can request it. If you've been turned down, the lender has to show you why. You know, maybe it's because you had a recent bankruptcy. Maybe you don't have enough credit history. You know, if all you've had is a Kohl's card and you want to go buy a $20,000 car, that might be a stretch, you know, to get a car loan like that. But
they wouldn't let me get a truck loan for a $40,000 truck because the last car payment I had wasn't over $40,000.
Yeah, well, it
was only what, 23,000. So I still had to get a cosigner. I had good credit, but I didn't have the right amount.
Yeah.
Of credit for the car.
Well, in a situation like that, you know, whether you can, you know, especially dealing with cars, there's lots of different ways to finance vehicles. Credit unions, one, you know, the dealers are almost always going to offer some kind of financing. A lot of times the manufacturers are behind the financing. They want to sell cars, so they're motivated to make car loans. But there's a lot of stuff that goes into that, what's called underwriting. And if your credit history, like Jonathan was just saying, doesn't have enough of those kind of large purchases, the lenders get nervous. I mean, they're not in the business to lose money. They want to be sure they're going to get paid back, because the worst thing that can happen for them is if you don't pay regularly, they got to go repossess the car, and then they got to deal with all that. You're still on the hook for the loan. They got to track you down. They got to put it into collections. They got to try to do something with the car. They got to store it for a while, maybe even sell it to try to get their money back. Lenders, it's a hassle. Lenders don't want to do that. I mean, they have to. It's part of the business, because there are people that either fraudulently get credit and buy things, or they hit a bad patch in their life and they can't make payments. So repossession is not something that anybody wants to deal with, for sure. They don't like it, and certainly you as the owner of the car would not want to be in that situation either. Not fun. Okay, this website here, cnbc.com. You know, pretty reliable news media outlet. This is actually a fairly old article. I'm sure there are updates to it, but it's generally still true. Credit score right here in the right underneath. What is it? It's a 3-digit number. There's a mathematical formula that the credit reporting agencies consider. Lots of different ways to do it. Sometimes further down the screen here, the FICO credit score. FICO is another nickname for the credit score. Scores range from 300 to 850. So somebody that essentially has no credit history still might have a 300 score. Higher number, low risk. You want the higher number. 850 would be outstanding. And if you look at this chart that comes from the FICO website, it's a general rule of thumb about how the credit agencies will evaluate your history and score your credit. A big chunk of it comes from your payment history and how much you owe. So you could have a good payment history, but if you've got 6 different credit cards out there and they're all maxed out, you might not have as high a credit score as somebody else who has basically no credit card balance, even with the same history, because the amount owed, in theory, is going to affect how much you can pay them back, right? So if you have a lot of debt, you have a lot of credit already that you owe people for. You know, you might have a 12-month same as cash deal at Best Buy. Maybe you've got a car loan. You've got, you know, 2 or 3 credit cards. I mean, you've got a Kohl's card, Target, you know, Macy's, all those. If you're maxed out on all that stuff, it's going to negatively affect your credit score because of the amount that you owe. The length of your credit history, less important, but still important. You know, those first 2 categories, that's 65% of what the lenders and FICO are going to look at. New credit, 10%. Okay. So you go in to make you fill out an application for a credit card, and the lender goes in to check your credit score and your credit report, and they see that in the last month you've applied for 5 different credit cards and gotten approved for 4 of them. They're going to be going, wait a minute, what's going on here? Might not get approved. It's going to probably affect your credit history negatively. Too much credit too fast in too short of a period of time is a red flag for lenders. You know, maybe it's unavoidable. Maybe you can explain that. But for the lenders and the people looking at your credit scores, it's just numbers. They don't know you as a person. You know, they deal with millions and millions and millions of people all over the country and all over the world. So it's hard for them to understand that there might be some background that could have an effect. And then the last 10% is the types of credit used. Is it mostly credit card debt? Is it a mortgage? Is it a car loan? Do you have 3 different car loans? You know, what type of credit are we talking about here? So all that goes into coming up with your credit score. So the article goes on to explain all that. And this particular site has something called a FICO score estimator to get your score range, perhaps. What does that look like? What is a FICO score? Bankrate.com. That took us right to bankrate.com. Of course, they've got promotions there. Simple calculators. Why is your credit score important? How is your score calculated? Here's the big thing though. How to get a free FICO score. Credit.com or Credit Karma or any of those, you see those ads all the time on TV. They're talking about getting you a free report. Well, they're not really offering you anything because you're entitled to that once a year anyway. That's part of the law. It's federal law. You can go get your credit report. Credit monitoring service, Experian. There's the third one. I couldn't remember that. Experian, Equifax, and TransUnion are the main three credit reporting agencies. Now, if you have a credit monitoring service through one of those, they're going to offer you a credit report pretty much anytime you want it because they're already looking at your credit. They're trying to make sure that you're making good decisions about credit and that nobody is fraudulently opening credit accounts in your name. The other thing a lot of people may not know is that you can freeze your credit. You want to unfreeze it if you're going to, say, go for a home loan or go for a car loan. But one of the benefits of freezing your credit is that if let's say somehow your identity does get stolen, somebody gets your social security number and they go out there and they try to start opening accounts in your name. If your credit is frozen, no one will be able to do that. So that's an additional protection that the credit reporting agencies provide for free. There's no cost for that. All you got to do is go on their website and register for it. So, and the nice thing about that, another nice thing is if somebody does try to open an account in your name, you're going to get notified because they're going to have your telephone number, they're going to have your email address, and you're probably going to get some notification right away. Hey, is this you opening this credit card account? Make sure you get that monitoring if you need it, and definitely look into the freeze as a form of financial protection. Credit seems like a good thing most of the time. Here's one of the materials that is in the lesson for this week. Don't jump at that credit card offer is the title. It's from a CNN report a while ago. In fact, if you'd rather just go to the website, CNN Money, I'm sure if you just type in "don't jump at that credit card offer," it'll come up in Google. So there are some important terms in here, and you can see this is fairly old. Talk about President Obama, so it's at least 5 years old. He wanted to see some credit card reform. He wanted to make it harder for credit card companies to hike rates and fees. What does that mean? Do you know how much the credit card company is going to charge you? Interest, for sure. What about fees? If you break a rule, you're gonna pay some fees. Yep. So what are some of the situations, Sarah, where they're gonna hit you with an extra fee? If you don't pay it on time, right? That's one.
or if you get your credit, or if you have a minus.
Oh, if you overdraft, if you go over your credit limit, yeah, that's another one. What if you don't pay the minimum? Every one of these cards, every account is going to have a minimum payment. You can always pay more, but they're going to have a minimum payment for sure. So you got to read the fine print. Any credit card offer, if you, the crazy thing is, banks and credit companies, they look to see who's gotten credit, because if you get some credit, you get a new credit card, what starts to happen almost immediately? You get more offers in the mail from other credit companies. It's almost inevitable, because they think, oh, hey, here's somebody, they got some credit, maybe it's a good customer, we'll offer them this, 0% transfer balances for 18 months or whatever, all kinds of stuff. Those other situations though, if you miss a payment, you're overdue, you go past your credit limit, you don't pay the minimum, it's not just the fees that they can charge you that could become an issue. And this is another thing that a lot of people don't pay attention to, and they really can get themselves in trouble. You got this low introductory rate for this credit card, 3% for 12 months. Great, you're running along here just fine. You miss a payment, you forgot. You thought you had it set up on auto payment online, but something happened. Or you changed banks, and you forgot to set it up on your new bank. Well, suddenly that 3% interest rate could jump to 28 or 29% interest. And if you run into problems with other issues that normally, it's not just going to be a fee, it could trigger the higher interest rate. Now all of a sudden that $1,000 balance, it's not generating 3% interest for the credit card company, is 28%. You divide that by 12, 28% per year. That really is going to add up in a hurry, especially if you have large balances. And so right here in this second paragraph, talks about APR, annual percentage rate. Got to pay attention to that annual percentage rate. Look in the next paragraph. Here's a guy from bankrate.com. We were just on that website. An effective APR represents your total cost of credit. So it's not just the interest rate that they charge you. It could be other fees. Maybe they charge you a membership fee to have the card once a year, $99 membership fee. It's just an excuse for them to hit you for more money. But it has the effect of essentially increasing your interest rate also, especially if you don't pay that. If you got one of these membership fees and you don't pay it all off, then now it's sitting there as part of your balance that they can charge you interest on. If you got a balance transfer fee when transferring the balance to that card, read the fine print again. Balance transfers from one card to another, they love that. Credit card companies absolutely love that, because the fine print will tell you, they're going to charge you 3% or 5% just to transfer the balance. So if it's $2,500 that you're transferring from one card to another, what's 2,500 times 0.05? That's $125 that they're going to get just for accepting the balance amount. And now your balance is increased by $2,500 on this account that you just transferred to. So now your interest rate's going to the amount of interest each month is going to go up.
So I have a question here.
Yeah.
So the transfer fee, if you have like, example, if I have like PNC debit card and I have Chase credit card, if I'm transferring from PNC to Chase, that's the limited transfer fee. But if I have a PNC credit card and PNC debit card, if I transfer, that's gonna also they're gonna take fee.
Well,
Transfer fee also.
you're asking about two different things here, really, because a debit card is tied to your checking account. Credit card is a loan. So if all of these are happening at the same bank, it's not really the same thing. If you're transferring from your debit card to a credit card, what you're doing is you're paying, I mean, because that money is going to come out of your checking account, and the credit card people on the receiving end are going to view that as a payment. It's not something that's adding to your balance that you owe. You're not borrowing that money. If you use your debit card, that's money you already have in the bank. It's not the same thing. If you're talking about credit card from PNC to a different credit card at Chase Bank, then you're going to pay a fee for sure. Debit card is different though, because that's coming directly out of your checking account. And it's one of the reasons why people say, don't use your debit card for online transactions. Because if you happen to get on a website that looks legitimate, but a scammer, if you use your debit card on that scam site, they've got direct access to your checking account and they can drain your account. If you use a credit card, the credit card company will back you up if you can show that there was fraudulent purchases or fraudulent uses of your card. You may only be liable for $50. For instance, somebody goes out and buys, a big TV, uses your card illegally. That's fraud. You're not going to have to pay for that. If they used your debit card to do that, you're just you're going to be out of luck most of the time. Yep. You're going to have to be able to explain it. PayPal is another good way to do protected transactions online, because that's a third party, and you have control over that. I mean, do you use PayPal?
I know.
Yeah. PayPal, you have to have money on account with them in order to be able to use it. So basically, you're going to take money from your checking account or from some other source, deposit it with PayPal, and then you can use that. PayPal will take care of all that online. Good, solid protection there for sure. PayPal has, they'll charge a fee to help you with the transaction, sure. Okay, $8 per 100, that would be 8%. That's pretty sizable fee. But there's lots of other services like that. Venmo is another one. Depending on your bank or credit union, there's a lot of people that you can pay, a lot of entities that could be paid directly electronically. You don't even have to go onto their website and make payments if you set it up right. Again, that's not credit related. That's checking. We'll be talking about bank accounts probably Thursday or maybe next week, because it's a different animal completely. That's money that you actually have.
Are you going to show us how to take a loan out and stuff?
Show you how to take out a loan? Not necessarily, not directly, because every lender is going to be a little bit different. They're going to have their own application. But they're going to mostly ask for the same information. How much money do you make? What other debts do you have? How much are you paying for rent or for your mortgage? You know, because that's all, and then they're going to pull your credit score and look at that also. So if you look at this example, here's our hypothetical person here. We're going to call him Tony. He applied for a credit card with a 0% APR for 1 year. So for that first year, there's no interest being charged. So he spent $1,000 on the card and decided to make only the minimum payments for that first year. Okay. Minimum payments probably maybe as little as $15 a month. It's almost nothing. You'll never pay off your credit cards if all you're doing is paying the minimums. Later on, Tony took out a $2,000 cash advance. Oops. But he didn't know there was a cash advance fee. And the cash advances that are a much higher rate than purchases. And Tony's not doing so good because now he missed a couple payments. It triggered 2 late fee charges. It also triggered a default rate, and his card rate was raised to 29.9%. He eventually paid off the entire card and closed the account. So Tony was tempted by the 0% introductory offer, but it cost him. Here's what he paid. $75 interest on those purchases, $379 interest on the cash advances. Why would a cash advance be at a higher rate than purchases? Well, that's actual money that you're getting from that creditor. You go to the ATM, take out $500, that's a cash advance. That is a cash loan. When he got the cash advance, they hit him with a $60 cash advance fee. And he forgot, he made his couple of late payments, $78 late fee charge. So on all these costs, he spends $592. And so his effective annual percentage rate was 19.7%. He thought he was getting a 0% card. Well, some bad decisions on his part, some bad management, and he ends up paying for it dearly. And this is a classic case of if it sounds too good to be true, it probably isn't true. So if you're going out looking for a credit card, these are some of the things you really should look for. The introductory rates are oftentimes going to be very low, maybe even artificially low to try to entice you to get their card. You want to be sure and look at what the payment schedules are. Is it due on the 1st of the month? Is it due on the 20th? What is it? How does that fit with your pay schedule? You know, if you get paid only once a month, that could be an issue. Definitely want to look at cash advance fees. There will be cash advance fees, and those can be quite high. You can have late fees. Those don't even relate to the interest. It's just going to be a flat dollar amount, you know, $39 per late payment, for instance. Some of them might have an interest rate associated with it too. Then you're going to have default interest rates. So if you violate any of the terms of the credit agreement, they can hit you with this default interest rate, which will automatically increase your interest rate. Don't want to do that. Yep. Went from 0% to 29.9%. So something for sure to avoid if you can, and to be looking out for when you start shopping around. But in your materials, you should be able to find this practical money skills handout on credit. And it starts off with some different scenarios. And these are kind of all good food for thought, you know, different situations. Answering yes means somebody should use the credit. Answering no would mean it's not a good idea. Or if you say it depends, okay, what does it depend on? So the first one says Marge, who's 18, she plans to buy a car on credit so she is able to drive to school. Is that a good idea? Brianna says it depends. I like that answer because that's what I would say. What does it depend on, you think? Yeah, depends on how much she makes, how much the car is. She's going to school. Is she going to be able to work enough to afford the car? I don't know. We don't know. We don't have that information. Makes sense that she would want to have transportation to get to school. But like Brianna said, it might be a good idea to look at those other factors. How about number 2, Fran and Bud, good old Fran and Bud. They recently took out a loan for a new roof. Good idea? All right, we got one vote again for it depends.
Yeah.
I would say yes with a qualifier. Before I do that though, what do you think that would depend on, Brianna? Okay, she says it would depend on how bad the roof is. Okay. Well, you have to assume that they own the house, right? They're not gonna replace the roof on a house that they don't own. So if it doesn't need replaced, you're not going to replace the roof. There are some situations though where you might be required to replace the roof. Maybe they're thinking about selling. Maybe the roof is near the end of its life. You know, roofs typically only last 20 to 25 years before you have to redo them, especially around here. So, you know, if Fran and Bud are thinking about whether they're thinking about staying or selling, a new roof is going to protect their investment. You know, water can do damage and will damage your property if you don't have it sealed up from the outside. And the roof is the first line of defense. So, you know, if the roof's only 5 years old, you don't want to replace it. You wouldn't want to get a new loan for that. The other thing is that they're homeowners. They might be able to use equity in their home. If they've lived there already 20 years, they've got a substantial amount of value that they've already built up in terms of payments to the bank. So you might be able to use some of that equity to replace the loan. Banks prefer that. They would rather have that added on because that means you're going to owe them more money when you sell the house. Next example, Edgar's 20. He recently used his credit card to pay for textbooks for his new semester of classes. Yeah, we got a couple of votes for yes. Could it depend on something? I don't hear anybody saying it's a bad idea. And I would agree also if, for instance, if he has a source to pay that back quickly. You don't want to buy textbooks and then have to pay interest on those textbooks, right? If he's waiting for his student loans to come through, Yeah, use the credit card, 6 weeks later, your student loans come through, you pay it off. No, you don't want to be getting charged interest for books that are going to be no use to you when the semester's over, unless you just like to collect textbooks. The other thing is a lot of credit cards offer you points. Maybe he's after those points, and so a credit card purchase like that helps him build up his points balance. You can use those points sometimes to buy down your interest rate, or to get other benefits from the card company. Which leads me to Marcia, who's 28 and charges all her groceries on her credit card. We got one vote for no. The only reason to do that would be if she gets points and if she pays it off every month. Because groceries are consumables. Those, you don't want to be continuing to pay interest on stuff that you've already bought and eaten. Not on consumables. That stuff's gone and you're still paying interest on it. Not a good idea. But again, if it's about points and she has the ability to pay it off every month, no big deal. Some card companies like American Express, you have to pay off their balance every month. So in essence, some cards are like short-term loans. If you have the money to pay it off at the end of the month, no, it's not a problem. Most people don't. My favorite example is coming up next. Sandy and Carla, they're 24 and 27. They're planning on buying a boat on credit for use during the summers. Carla will be the main signer for the loan, with Sandy being the co-signer. Okay, we got a vote for depends. And why do you think it depends, or what does it depend on? Okay, depends on how much she makes, how much she can afford, how much the boat is. What were you going to say, Sarah? Really, what are they going to use the boat for? All it says here is that they're going to use it during the summers. What kind of a boat is it? Is it a ski boat? Are they going to go water skiing? Is it a fishing boat? What is it? Doesn't tell us that. I would be very skeptical about this arrangement. That's why it's my favorite example. These young ladies are still fairly young. They're in their 20s. Around here, how many months of the year can you use a boat? 2, 3, 4 months, maybe. You're going to go out and use it every weekend when the weather's good? Probably not. Where are you going to dock the boat? You're going to have docking fees for that. You're going to have to buy gas. You're probably going to need to get insurance in case somebody steals it. I think if you get a loan for it, they're going to require you to have some insurance, definitely. And what is the relationship here between Sandy and Carla? Carla's going to be the signer. She's the older of the two. Sandy's the co-signer. Are they best friends? Maybe they're partners, could be. What if they break up? What if they have a fight? Then you got this arrangement here. Who's going to get the boat? Who's going to use it? I got it this weekend. You got it next weekend. And if Sandy decides that she's going to go to law school and leaves the state and never pays on this loan again, what happens to the loan for poor Carla? What?
falls apart.
Falls apart, meaning she's holding the bag. She's got to make all the payments then. And if she can't, it's going to go into default and it's going to reflect on her credit score. I'd say, nah, boat's not a good idea, especially for two young women. You know, maybe they don't work. Maybe they can just hang out on the boat every day in the summer. I don't know.
Well, if they don't work, then they can't afford the boat.
Or maybe they're rich. And if they're rich, I guess they don't need a loan either.
Yeah.
I don't know. Not around here. Boats are not usually a good investment. Because what do you do with it in the wintertime? Now you got to store it somewhere. And if you don't have a dock, you got to get it.
My grandpa had a boat. We had, like, it was just too much, especially living here and not living on the coast. And so it was just.
Did you have
He
to
was paying more money to store it than us using it.
pay more for storage than using it? That's what I would be concerned about also. Plus, if you don't have a dock, you're going to have to have a trailer and a car big enough to haul the trailer with the boat on it back and forth to the lake all the time.
Too much work.
Not a good idea around here. So next section here talks about things you can do to build a credit history. We've talked about a lot of those already. You know, go to your credit union, get a department store card, start off with a low balance, a low limit credit card. You know, that would be a spot just to jot down some things.
Is this one?
No. The next section here will help you understand things maybe from the perspective of the lender. And because it talks about something that they're describing as the 3 C's. Three things that lenders will typically look at. Character, meaning basically what kind of person are you? Capital, meaning do you have the money? Do you have money? Do you have a savings account? And the last C is for capacity. Capacity is about ability to pay back. So if you've just started a brand new job, you might have some money in savings so that you've got the capital. You might have a good payment history, so you've shown that you've got good character, but maybe you don't have enough history on your new job to really show that you've got the capacity, especially if, you know, maybe you've got a 60-day probationary period and you could lose your job after the 60 days if it doesn't work out. You know, creditors, lenders are going to be concerned about that. So any of those 3 could fit for these situations. Do you have a savings account? Well, that goes to capital. Capital with an A is about cash. Capital with an O, CAPITOL, is what Indianapolis is for Indiana. Indianapolis is the capital of the state of Indiana. We're not talking about that kind of capital here when it's spelled with an A. When you have, it sounds exactly the same. It's one of those homonyms, means something completely different. Have you used credit before? That goes to your character. Did you pay it off? Did you default? Did you leave the state and leave someone else holding the bag like Sandy did to Carla? Now, number 8's an interesting one. How long have you lived at your present address? Why would a lender want to know about that? So they could find you? Could be. Sometimes lenders will ask for your current address and maybe the last 2 addresses before that. Where have you lived? And how long were you there? Not necessarily to see how much money you have. Yeah, they want to see if you're paying rent, or are you just bouncing from place to place? Yeah, if you had a problem someplace else, you maybe, you broke your lease and you moved out early. That can happen. Maybe you bought a house or something and you defaulted on that loan. You left after 6 months. A lengthy time at a particular location implies that you're stable. You've got some stability in your life, which, for a lot of people, once you have a family, start having kids, you want to settle down. You want to put roots down someplace. You want that kind of stability for yourself and for your family. So
I've lived in the same house my entire life.
You've lived in the same house your entire life?
And my parents owned it before.
Okay. Think about people that grow up on a farm, for instance. Maybe that farm's been in the family for generations. When you get into urban situations, it can be a lot different. So the stability that's shown by your current address and how long you've been there is a valuable thing for a lender. So the fact that you've been there your whole life, that would be something that they would be interested in knowing.
My grandparents lived 6 doors down, so my mom grew up in 6 doors down.
Oh, yeah.
And I think my grandparents have been there for like 40 years.
Well, that's some real family stability then, if they've been in that same area for that long.
Sorry, I'm getting off topic, but my grandma always tells the story, like they were like one of the first houses in the neighborhood. She said she woke up one day and there was a road, like there was a street on the road, because it was just a dirt road
Yeah.
forever. She said she woke up and there was concrete.
Well, wow. Yeah, that can happen in developing areas for sure. So number 9, do you have a steady job? Well, that's going to go to your capacity. How long have you been at that job? Do you pay your bills on time? That's a character issue, and they'll look at that from your credit history. What are your current debts and your current living expenses? That's going to be capacity again. Can you take on more debt? Lender always wants to know if they're going to be paid back. Now, the next page at the top of the page starts talking about some different types of credit. Things such as simple payment credit, single payment credit, installment credit, and revolving credit. They're all very different. Which do you think would a monthly payment on a car loan be? That's actually considered an installment type of installment credit, because you know the total amount that you owe with interest, and then that's just going to get divided by the number of months that's on the loan. So it's the same amount every month. The amount that you owe goes down as you pay. You don't get more credit. You don't get to spend that money again once you've paid the car loan company. So you're paying it in installments that are typically equal until the loan is totally paid off. Telephone bill and heating bill are going to be considered single payment credit? Well, why would that be considered credit? Well, the telephone company, especially if you have a landline, I mean, it's the same thing's true with a cell phone. Telephone company is providing you with a service, assuming that you're going to pay them at the end of the month or whenever the cycle is. Heating, the gas company, electrical company, they do the same thing. And what's their recourse? If you don't pay them for 2 or 3 months, they're going to cut you off, right? And they might send you to collections where you got to pay an extra fee to get your services turned back on. Or you might have to pay a deposit money with them that they hold on to, not money that you planned on giving up to the electric company or the phone company or the gas company, for instance. And a lot of those, you know, even like cable TV or internet stuff, they actually, some of those now have gone to charging you in advance. You're paying for the next month of service in advance of you actually receiving it. That's been something that's happened more over the last 20 years. How about 19, using a credit card to buy a new jacket from a department store and then paying the charge off over several months? That's most likely a type of revolving credit. Because if the department store is going to give you a card, let's say your limit is $500, you can't go over that. You know, you could go spend $495 on that jacket. You don't have any more balance anymore up to your limit. It's only $5. So you can't really use the card again. But as you pay it off, now you've got balance coming back in there that you can actually use to spend again. So that's why it's considered revolving. You buy and you pay off. You buy and you pay off. Or you buy a big purchase and you pay until that balance comes down. The next one is just a more refined example of that, using a major credit card to buy a pair of shoes and paying the total amount of the credit card balance within a month. Okay. So you're paying off the whole balance. Okay. Now you've gone from, say your credit card limit is $1,000. You buy a pair of shoes for $100. Your balance goes down, your available limit to $900. You pay off that $100 plus interest. Now your credit limit's back up to $1,000. So it's always about how much is outstanding, because essentially the card companies have loaned you the funds to buy those things. You got to pay them back. But as you pay them back, then you get that spending power back again in terms of anything that's available up to the limit. So those last two are really revolving credit because it's a changeable amount. Here's some fun true or false questions to see what you actually know about credit and what lenders can do. True or false? It is legal for a creditor to deny an applicant credit based on marital status or age.
False.
That is false. That's discrimination. I'm sorry, sir. We're not going to give you a loan because you're 70 years old. Huh? No. I got good character. I'm not 70, so I'm not talking about me. I got character. I got capacity. I got plenty of money in the bank, so I got capital. Why wouldn't you do that? You can't do that. You can't discriminate against people. Lending is about like housing or other benefits anymore. You know, there's all kinds of anti-discrimination laws. Next one, if you are denied credit, the creditor is not legally obligated to explain why.
True.
No, it's false. They have to tell you. They have to explain why you were denied. You don't have enough credit history. You have too much outstanding credit. You don't make enough money. You need a co-signer, like Jonathan was talking about. They have to tell you. Otherwise, they could just deny people willy-nilly for any reason that they wanted to. That's one of those legal protections that that has come into play over time as our societies become more credit dependent. They can't just make arbitrary decisions and not tell you why. So far, we got 2 falses. So next one, when creditors evaluate your income, they can't legally refuse to consider income from public assistance in the same manner as other income. Well, what if you're getting Social Security? What if you're getting some other kind of subsistence payments? What if you just got a stimulus check from the federal government? Can they say, oh, we're not going to count that? That's not regular income. No, they can't. They have to consider that just like any other income. So this one is actually true because it says they can't legally refuse. So it's worded kind of oddly, but it is true. They can't legally refuse to include that other income. They have to include it. '24, if you are refused credit because of your credit report, upon request from you, the lender must give you the name and address of the credit bureau that issued the report. True, yes, absolutely. We talked about that before. Anytime you get denied, you're entitled to request a copy of that report. Why would you want a copy of the report? Because when you got denied, to make sure who's not lying. The bank or the credit agency? The credit agency, and I'm smiling because your comment shows a reasonable distrust of the system. And I don't mean that to say that those big credit reporting companies are going to lie to you, because all they're doing is reporting what's been told to them. So they're just gathering the information and they're spitting it back out in a report. But somebody else might have given them bad information. Think about people like that. If you think about how many guys named John Smith there must be in America, how easy would it be for some other John Smith's credit information to end up on your report? Okay, maybe John Smith is, maybe it's a different John Smith. Well, you want to look at your credit report to figure that out, because if there's something that's factually incorrect, you can get that removed. You can appeal that, and maybe that's what got you rejected. Maybe somebody else's information accidentally got on your report. It's not the credit agency's fault. Somebody else mixed up, maybe they transposed 2 numbers on the Social Security number. Who knows? Mistakes happen. And so it's another good reason to, even if you're not seeking credit, but you want to know annually, check your credit report, make sure that there's nothing unusual on there or incorrect. It's also an opportunity for you to figure out if there's any fraudulent stuff, any fake accounts that have been opened up, and maybe you've been a victim of identity theft and you don't even know it. Credit reports, good to check on a regular basis. 25, your credit report is available to anyone regardless of the reason.
True.
No, that's false, Ruth. No.
Why?
No.
Oh, I confused because I think it's when they check, some company check your credit report. So.
Yes, but you have to give them permission.
Oh, okay. I got it.
If you're filling out a job application, somewhere in that job application, it's going to say you're agreeing to them having the right to check your credit from any of the major reporting agencies. you know, I can't go check your credit. I can't go check anybody else's credit. I can't do that without their consent, and neither can a business or a lending agency. They can't do that without you giving them permission. And the credit reporting companies, they're gonna ask, hey, you're not this person. What gives you the right to check this person's credit? They're gonna have to provide proof to the credit reporting agency that they got your consent. Another one of these protections that we have as consumers. You know, we're not big business. We don't have millions of dollars to fight this stuff. The laws had to be put in place to keep abuses like that from potentially happening. Because what could happen? Somebody get a copy of your credit report and put it out on the internet, you know, because they had a fight with you and they're trying to, you know, cause you harm. You just can't allow that sort of thing to happen. I mean, that's what the law is there to do, to protect us. The debt collector has the right to contact you at any time of day or night. False. That is false, right? They can't contact you at work. They can't call you like after 10 o'clock, you know, because certain types of collection activities are considered harassment. And again, it's part of the protections that have been built into some of the consumer protection laws over the years. To be within a safe debt load, your total credit should not exceed 20% of your net pay after subtracting rent.
True.
Yeah, that's a good guideline. Because if you make $1,000 a month and your rent is, let's say it's 500, that leaves you with 500 for other expenses. 20% of that would be $100. So you shouldn't have any more than $100 in debt if those are the numbers that you're working with. $28, we just talked about. What should you do if you find there is inaccurate information on your credit report? You want to go on to their website, file a complaint, or send them a letter, and your part of your record keeping should be to make sure that you keep a copy of that correspondence. I sent them a letter. Well, where is it? You might have to produce that at some point. If a dispute gets big enough where you have to sue somebody, you want all the documentation you can gather. Generally, how long can a consumer reporting agency report unfavorable information? Most of the time it's 7 years, 5 to 7 years for most things. Like bankruptcy. You don't want that on your credit report forever. You want to get out of that. You want to get out from underneath that eventually. So any questions, anybody? I got a quick video to share here about what happens if you get into trouble. Anybody know what the debt snowball refers to? For a debt snowball, we're not talking about a little ball of snow that gets bigger and bigger and bigger and crushes you at the bottom like you see it in cartoons. This is actually a process to go through to eliminate your debt. Really quite helpful in some situations. Come on.
Today, I'm going to show you what finance expert Dave Ramsey calls the debt snowball. It is the best and fastest way for you to get unstrapped and to be free from the bondage that debt can have on you. Let's take a look at our first column. This is a column of imaginary debts that we may owe places or people. So we got Lowe's here, the interest rate that we're paying right now on this $450 that we owe Lowe's for that grill that you had to have, or those power tools that were just the newest and the best for you, or the lights you had to put around your house. $450 we owe, and our minimum payment that we're paying right now for that is $50. What else? We've got Target. This was for the lovely summer dress that just looked so cute on you, and the shoes that you had to get with it, and the accessories, and not to mention the pickles, the mayonnaise, and the ice cream for the late night cravings because you happen to be pregnant. $650 you owe to Target right now, and the minimum payment is $30. One more thing, we got our parents right here that are loaning us some money because we had to fix the air conditioning and some other things around the house. We owe them $1,600 at 0% interest. Thank you, Mom and Dad, for not charging us that. Right now, we're paying them $200 a month to try to pay off that debt we owe them. Now, we're paying the minimum payment. It's going to take forever. How do we get aggressive and really attack this? It starts like this. You have to come up with $200. How are you going to do this? I have no idea, but $200 per month, you have to come up with somehow. It's time to get creative here. Maybe it's getting a second job for a little while just to add some hours so that you can come up with this money. Maybe it's canceling cable or satellite TV. Maybe it's not having that mobile data plan on your phone. I don't know, but figuring out a way to come up with $200 per month. Watch how that's going to work for you now as we attack our debt. So we take Lowe's. We owe them $450. We've been making our minimum payment of $50 faithfully, and that's great. But that's going to take forever if we do that. So this is what we do. We take our $50 that we're paying, that $200 that we came up with, we add that together. It's $250 that we're going to start paying per month to attack Lowe's. Now think about this. In just a couple of months, $450 done. Lowe's is completely taken care of. Wonderful. Now watch how this is going to start to snowball as we go through this. Let's attack Target now. Hit the bullseye, if you will. We owe $650. We're paying our minimum payment of $30 right here. So we add $250 to that. Whoa, Joey, where did the $250 come from? Well, don't forget, we're no longer paying our $50 minimum payment to Lowe's. So we add the $200 that we already have to that $250. So now it's our minimum payment of $30 plus $250. It equals $280 that we're paying per month towards Target. Now look at this. Just a few short months. What are we going to be able to do? We're going to cancel out that $650 debt. We're going to cancel out Target now. Let's continue. Now we've got our parents. And so we owe them $1,600. We've been paying them $200 a month. Look how that works. We've been paying the minimum payment plus $280 because we're no longer paying these minimum payments plus our $200. So equal that out, $480 we get to pay our parents per month. And just before you even know it, parents taken care of, they're going to love you. They're going to say thank you for paying that off so fast. So you can see how it keeps piling up and how fast this thing actually is going. Now, how does this help you for the future? What I'm about to show you is amazing. Now, if you just pay your minimum payments like so many people do, guess how long it's going to take to pay off this whole board? Just by paying the minimum payment, it's going to take you 120 months. That's 10 years of being strapped. Now, if you were to do the debt snowball and get aggressive at attacking your debt like I just showed you, guess how long it would take for you to pay off this entire board right here? Only 21 months. That's a difference of 99 months. But it gets even better. If you take the $1,110, where'd you get $1,110? Look at our payments right here. We freed up all of our debt. And by the end, this is how much money we have left over per month that we just have now that we're not paying towards debt. You invest $1,110 at 8% for 99 months. Guess how much money you would have in that period of time? $153,992.30. If you take that money and invest it at that, instead of paying minimum payments, we're investing now in that same amount of time. Look at that money. How much money is that? You buy a house with that in most parts of the world. So think about this. The debt snowball now has created, in this period of 10 years, you're completely debt-free and you can pay off your entire house. That is simply amazing, but it's going to take effort on your part for you to be committed to the debt snowball. Let no debt remain outstanding except for the debt of love that we owe one another. We don't serve money, we serve God. Money serves us, as we serve God. If you choose right now to live like no one else, one day you'll be able to live like no one else.
Interesting concept. And it assumes that you don't add any new debt during that time. So debt-free, wonderful idea. Most of us aren't able to do that. Still have to have money for a car loan, and maybe you're still paying on a house, but great process if you're trying to get out of trouble. Questions, anybody? That's all we got for today. All right, get back in there and keep working, get that first unit test done. It was released last week. Okay, see everybody Thursday.
Bye, Jay. See you Thursday.
All right, thank you.